Beginner investing mistakes can cost you a lot of money, all the way from losing a few pounds to obliterating your entire portfolio. But the good news is that these mistakes are totally avoidable if you know what to look for. In this video, I'll run through top 10 investing mistakes, some of which I've made personally myself in my own investing journey. A lot of would-be investors put off investing money for various reasons, but one of the most common excuses is that they're waiting until they earn more money. To avoid investing regret, it's generally recommended to start investing as soon as possible. This is because with more time, you'll reap the benefits from compounding, which is the interest earned on your invested money. Some people put off investing to prioritize other financial goals, but it can really pay off if you're able to manage all of your financial goals at once. If you put off investing, you're potentially missing out on years of compounding growth. If you have any high interest debt paid off, an emergency fund in place, then start investing now with realistic amounts, regardless of how small. This is much better than waiting for the perfect circumstances, which most of the time just don't exist. Due diligence is basically the research you do to fact check and identify risks about what it is you're actually investing in. Not doing your own research could be detrimental to your investment journey. For example, if you're really keen on picking your own company's stocks to invest in, it's imperative you research the company yourself and not just pick a stock based on a random recommendation from a friend or someone on YouTube. Some of the things I do to research a company before I invest include reading reports on the financial performance of the business, looking at the management team, reading annual reports, and making sure the business has a competitive advantage. If you really want to just keep things simple though, you could just pay into an index fund every month and do away with any time-consuming due diligence. But it's really personal to you. I really do think it's important to set goals for yourself to stay on track with your investing journey. Of course, it's possible to forward plan every single detail, but it's important to know why you're investing in the first place, as everybody's life goals and expected outcomes are totally different. It's really easy to continually compare yourself and your situation to others around you, but the chances are they're starting off in a totally different place with different resources available to them, and you have differing outcomes. So it's worth breaking down your own personal goals. Ask yourself where you want to be in 5, 10, 20 years' time. Are there certain things you want to save for? For example, do you want to invest in real estate at some point down the line? If you don't know why you're investing, it's really easy to lose patience with the investing process and fall off the bandwagon. Nobody knows with any clarity what the stock market is going to do. It would be absolutely fantastic if we could all just start investing when the market was at its lowest point, but you just never know what the next day can bring, and that's the nature of the beast. Some speculators and day traders do try to constantly time when to buy and sell on the stock market to make fast cash, but it's an extremely risky endeavor, even for those that trade full-time. Time in the market generally beats trying to time the market, and it's more important to start investing today. Time is really what counts when it comes to long-term investing, and it's how I personally try to manage my own funds. With stocks and shares, the easiest way to diversify your investments is to invest in index funds or ETFs. I talk about the benefits of these funds in my previous video on investing for beginners, which I'll include in the information card above and link below. ETFs and index funds are simple to understand, and they're a great way to automatically diversify your investments without buying hundreds of different stocks and shares yourself. They also beat over 85% of hedge fund managers and professional investors when it comes to returns, so they really are a proven quick win if you're looking for variety in your portfolio. You should also consider diversifying your cash outside of the stock market as well. Two good examples include buying real estate, or if you're less risk averse, buying cryptocurrency. But there are plenty of other assets to invest in, including commodities like gold, government bonds, etc. When you're starting off your investing journey, it's really important to get a sense of what works for you and what doesn't. Investing is definitely a learning experience, and there's a lot to be discovered as you go. So while it's good to get started as soon as you can, you don't want to rush into anything too quickly. You really want to invest your money with a long-term lens, rather than just see it as a fund where you can just constantly move money in and move money out. Investments typically mature over time and should be left for a minimum of 3 to 5 years. For this reason, you don't want to be over-invested and potentially lose a portion of your investments if you need to withdraw funds when the stock market is in a slump. Essentially, you want to avoid investing money that you might need in the short term, whether that be for an unplanned event such as an emergency or something planned like removing money for a house deposit. This is why it's key to set up an emergency fund before beginning your investment journey. This is definitely something I myself have been guilty of in the past. Investing based on emotion is the main reason why so many people buy at market highs and then sell at market lows. Making knee-jerk reactions to fluctuations in the market based on emotions can really make it difficult to stay on track and achieve your long-term financial goals. Fear, hope, and greed can make investing a bit of a roller coaster ride for you and isn't conducive to making rational decisions about finances. One of the best ways to avoid emotional investing, especially during a downturn, is not to fall prey to media coverage, whether that be mainstream news or social media. Market volatility makes for attention-grabbing headlines, and while it's fine to stay up to date with the news, successful investors don't overreact by engaging in behaviors such as panic selling in a market slump or excitement buying during a market upturn. Tax implications really depend on your own individual circumstances and need to be looked at on a case-by-case basis. In general, though, one of the best things you can do to reduce the taxes on your investments is to invest in a tax advantage account, such as an ISA or your workplace pension. You can invest up to £20,000 tax-free in a stocks and shares ISA each tax year. You can also benefit from income tax relief and matched employer contributions if you invest into a workplace pension or private pension, which is basically free money or cash that would have otherwise been lost to the taxman. Overthinking really is a big one when it comes to investor mistakes, and it manifests itself in different ways. Some people will let perfection overwhelm them and refuse to get started before they think they can build a perfect portfolio. Other people overthink about what the stock market, the economy, or the government might do, and then they delay investing until they feel more secure about whatever it is that they're worrying about. Other people will overthink about what everyone else is doing, not wanting to make a mistake, as if there's a perfect formula to investing. The truth is that there's always going to be something to obsess and worry about, so you'll never actually get started if you succumb to these worries. Just keep your strategy simple, but make an effort to learn, observe, and continue to build on your foundational knowledge. Always remember that the best way to learn is by doing, not thinking. So try not to overthink. It's likely that you'll incur costs on the platform that you use to invest your money, as well as costs associated with any funds that you choose. Remember that every pound you spend on fees is a pound that isn't compounding and growing for the future. So you need to be mindful of what you're paying. Make sure you're on top of the charging structure for the platform you're using to invest. As a general rule of thumb, it's more beneficial paying fees as a percentage of your investment if your portfolio is smaller. If you have a bigger pot of money though, or your investments grow over time, a fixed fee platform is more advantageous from a cost perspective. Additionally, to keeping costs low, look at the cost of what you're actually investing in. I would stick to low-cost, passively managed index funds and ETFs for the most part to keep your costs right down. So there you have it, my top 10 beginner investor mistakes and how to overcome them. If any of these mistakes are familiar to you, or if there's anything that you think I've missed, feel free to drop your thoughts in the comments below. Thanks for watching, and I'll see you in the next video.